Can the U.S. avoid a recession in 2023? The U.S. economy just shown that it is making progress against sky-high inflation, which suggests that a recession this year may not actually occur. If you are new to the channel, please make sure to subscribe and give this video a thumbs up. One indicator of inflation, the Consumer Price Index, increased 6.5% year-over-year in December, a significant decrease from the figure of 7.1% in November. This number has decreased for 6 months in a row as of December, indicating that inflation has been slowing. According to Mark Zandi, chief economist of Moody's Analytics, inflation is on its back heels. The Fed shouldn't be under as much pressure to raise rates in the future, he added, as the broadly lowering inflation substantially increases the probability that the economy will navigate through without a recession in 2023. Throughout 2022, the big question as Americans continued to battle high prices was whether the Federal Reserve would push the economy into an economic downturn. The Fed increased interest rates 7 times in 2022 in an effort to restrict economic growth and control inflation, and because of its forceful methods, several analysts and politicians were afraid that the tightening may result in job losses and a future recession. At the same time, the U.S. job market has virtually shrugged off the prospect of a recession. Workers continue to leave their jobs at almost record-high rates, yet the unemployment rate is still quite low. The U.S. gained 223,000 payrolls in December, far more than the 200,000 jobs predicted by the analysts surveyed by Bloomberg. The unemployment rate also decreased to 3.5%, which was less than the expectation of 3.7%, despite greater improvements in the U.S. in the first few months of 2022. The increase in employment in December is nevertheless evidence of a strong labor market. Following the employment report last Friday, Nick Bunker, director of economic research at Indeed Hiring Lab, told Insider that the data that we have until the end of 2022 makes me feel more hopeful about 2023. Data released on Thursday also revealed a decrease in unemployment claims, another sign that mass layoffs have not yet occurred. For the week ending January 7, seasonally adjusted initial claims decreased from 206,000 to 205,000. Additionally, Thursday's data said that continuing jobless claims decreased from the prior week's 1,697,000 to 1,634,000 for the week ending December 31. The BLS data on December payrolls, according to Labor Secretary Marty Walsh, contradicts all those talks about a recession. Slowing inflation as measured by the CPI, robust non-farm payroll gains, and other positive data points together may mean the U.S. can avoid a recession. According to Sinem Buber, head economist at ZipRecruiter, the most recent CPI announcement increases the chance of a soft landing, a term used to describe a return to low inflation with a robust labor market and overall economy, combined with recent labor market indications. President Joe Biden stated on Thursday that the current inflation figures were excellent news, wonderful news about our economy. We still need to do more, but we're headed in the right direction. Across the nation, there are areas where fantastic things are happening that are shining brightly. Good signals include employment growth and declining inflation, but it still rests on the Federal Reserve. Miracle and Phillips wrote in a January 5 article that the firm estimated the probability of a recession this year is 35% due to its optimistic view on whether a recession is necessary to tame inflation. In contrast to what past correlations would imply, Miracle stated, we anticipate that a protracted period of below potential growth might gradually rebalance supply and demand in the labor market and temper wage and price pressures, with a considerably more restricted increase in the unemployment rate. Of course, how the Fed decides to proceed during the year will have an impact on economic growth. The nation's central bank increased interest rates by 50 basis points in December, a slower pace than the 75 basis points it had previously increased them by in response to encouraging CPI data. The Federal Reserve, Fed, may react favorably to Thursday's CPI report, despite the fact that the FOMC meeting minutes from December said that the Fed is not considering lowering interest rates this year. Zandi concurred on February and March hikes, but said it'll be a real debate whether they need to go any more after that. They don't need to, in my opinion, he said. While Fed Chair Jerome Powell has already stated that it is unknowable if a recession would occur this year, if the economy keeps showing signs of strength, the Fed's ultimate objective of a soft landing, combating inflation while averting a recession, may very well be within reach. Nevertheless, Zandi predicted that there won't be a recession and that the labor market would continue to cool and the unemployment rate will continue to increase. "It's going to be a tough year," Zandi said, "but I think odds are increasingly likely that we can make our way through this year without a full-blown outright economic downturn." But how the U.S. can avoid a possible recession in 2023 as new interest rate hikes are expected. According to American economist David Miracle, while the chance of a recession in the United States during the next 12 months is 65% according to the mainstream estimate, in his opinion the probability is significantly lower at 35%. According to Goldman Sachs, Miracle noted that part of his team's disagreement with the widely accepted probability estimate comes from the belief that a recession is not required to control inflation. According to Miracle in a Goldman Sachs report from January 5, "We think that a continued period of below potential growth can gradually rebalance supply and demand in the labor market and dampen wage and price pressures, with a much more limited increase in the unemployment rate than historical relationships would suggest." He added that while the Federal Reserve tightened financial conditions substantially last year, the impact on GDP growth is likely to diminish this year. In other words, the drag on U.S. GDP growth from recent aggressive Federal Reserve policy will fade as 2023 progresses, he said. In terms of wage growth in 2023, Miracle said that by the end of the year, he expects wage growth to slow to 4% from more than 5%. This would still be a bit too hot, but any sizable drop would provide Fed officials with a proof of concept for the idea that gradual labor market rebalancing can dampen wage and eventually price pressures without a recession, he said. Expect more Fed rate hikes. Finally, Miracle said that he expects the Federal Reserve to hike rates by 25 basis points in February, March, and May, and to then hold the funds rate at 5 to 5.25% for the rest of 2023.